Hello and welcome to StiffX Trading Flow. We had promised that we'll upload a video based on average trading range or ATR. And very quickly, we say that ATR is simply an indicator that measures the volatility of the market of a specific period of time, so that you can be able to see how much in range from high to low of a candlestick that the price can move from its highest and the lowest of the day over the last period of days. It can be 14, can be 50 days, 100 days, but in our case, we like using the 200 days. And first of all, want to see the indicator is always found here under the oscillators. It is ATR, this one. So you change this one from 14 to 200, as simple as that. And by that, you have your ATR. This is one of the most ignored tools of trade of us, quite over a long period of time. But once again, it's one of the best you can use, especially for risk or what we call the trade management. It helps you to be able to gauge how far can a price move from its lowest or from its highest to the lowest. So you can be able to do that. Otherwise, you can also be able to automate it, like you can see here. It's just two lines, a very simple indicator because it's just a basic indicator. You just need two lines of code of MQL4 code, and you have it here. That's why you find it on the chart. And like in our case, I don't use the indicator. I use the simple automation, whereby it's just an ITR. Because you can see it's this is I've used the variable 1 ATR value for one specific day over the last 200 days. Under any chart, the symbol that is there on the chart is all that will have the period. It can choose. You can be able to put either period day one or this one underscore period. And this one will represent any type of trading chart you are either in minute one, day one. In our case, we'll use daily chart. So shift is 0. So you're using under the current candle and simple comment whereby the trade can be able to tell you. So this is just like a string whereby it's a sentence telling you that 1 ATR value is equals to this variable here, which is the 1 ATR value that will be calculated by the chart. And if you come on the chart, the same thing, we have your 1 ATR value is equals to 0.63. You can also add some other things, but for today, you not use. And you can check you have the same reading here, 0.6303. So you can be able to tell under a simple calculation that this one is under only 0.6303. So this is 63 pips that silver USD will move over the last 200 days. So if you take the highest and the lowest of the price and then the average over the last 200 days, that means for the last 200 days, the average is 6303. We'll see how 63 pips. So if you're putting any stop loss after you buy or sell in such a market, that is where you're supposed to place your TP or your SL. It's as simple as that. And that example can be demonstrated in some of the charts. Like we have, like yesterday we had Euro GBP buy. This trade was one of our best for yesterday. You can see, like in such a moment, we had bought at this price value because this was the open. From this candle, this was the cross on Friday. This was the open yesterday. So from here you have 0.8750, and the ATR you can see is very simple. That it is it's an average 70 pips over the last 200 days. That means it's just 0.0069. If you take these 6 and you average to the next one digit or 5 point, that is 0.0070. And if you take the pip value for any trade with or any decimal point that are more than 4, you know that these two, this is a pipette, this is the pip value. You know how to calculate these pip values from this point. That tells you that this last is what you take as the 70 pips. There are more codes that will add to this so that you can be able to calculate specifically at 70 pips. As simple as that. So from that moment, you know here you are calculating only 69 pips from the entry. That's why we said if you give a trade like this one yesterday we had given, this means you just calculate 69 pips coming here below. So you can see 69 pips is at this price value. So you simply take a tell like this one when you measure the 69. So it is simply 0.8750 minus 17 minus 50 pips. This one will come 8680. 8680 is where you have our 70 pips range. So that's why you put the stop loss. But because of the news, so you have such big candles, other big candles, this is an average. That's why if the trade goes against you on an average of 70 pips, you don't need to be in that trade. But of course, you need to add something like 10 pips Like in our case, we like putting at after 10 pips, so around 86, 70. You add 10 more. Why? Because of this excessive moves of the market. But when the price is moving the direction of the market, or in your current direction of the trend, after you've checked your entry, you will find the market will always move in your direction. But after that, then when you're putting your TP, you need to put at exactly 70 pips. That's why we said you need to be opening 2 trades at any one time. If I'm at 87.50, you know the next 70 pips is 88.20. And you can see the market did hit one ATL value from the ask price or from the buying price, which is taken as ask price here. So it did hit just exactly 1 pip, and then it came back. So when you close here, that's why you always advocate that you trade only, you take 2 trades all the time. Like in our case, we like taking 2 trades. So when the first one hits, then you move your stop loss from this point, because over 90% of our trades will hit our 1 ATL value. Then you close in with 1 TP with 10 pips, you break even. Then you're on the side of you're on the positive side. That means now this trade becomes risk-free. So even if this price comes back and hit this point, that tells you that trade is not on your side, or that trade will close with 10 pips profit, because there are some candles that you may buy maybe from this candle and continue moving up for the next 5 days. Then you can be able to take the maximum pips. But the TP, the second TP, will always put it at 2 ATL values. That means from 88, 20, it was 70, 87, 50 was our entry, and you are taking 2 ATL value. If 1 ATL value is equals to 70 pips, then you are going all the way to 140 pips. That means 87.50, 88.50, that's 100. Then you take another 40. So it comes to 88.90. 88.90. 88.90. That's why I will put my other TP2. So this one, the price can move all the way to this TP2. And you check the most of the cases what happened in this market. The market will move an average of 2 ATL values, then retrace back. But if it continues trailing, then, but when the price continues moving up and crosses like over 100 pips, the trailing stop loss, this one will continue following the current price with 100 pips. That means it can move all the way until if it hits this point, it crosses everything. But even if it moves and follows for like it moves to 200 pips, and maybe the ATL was like 200 pips, or continues here and moves like 180 pips, has not yet hit the 2 ATL values, and then it comes back, you still have some profits here to bank. That means that you are trading as a very smart trader. And that's how you do trade. And that's how we do money management. So every time you are trading with us, make sure that's the way you are following all our trades. So every time we place an entry, that's the way to do. Like today, we almost pin our 1 ATL value level. So be checking at this one. If you are good at coding, even if you have better codes, it's the moment that we are developing our system, and it's almost true. We have done all that. If you check like in our code here, in our buy order, you can see that from the entry, the TP is 1 ATL value, TP is the buying price plus 2 ATL values. That tells you. So for the stop loss, we are putting a risk of another 100 pips here, or 20 or 10 pips. This is the code. You see, we are using 2 orders. If it's buying, we are buying 2 orders at the same time. So that's what we are developing. For the TP1, we said 1 ATL values, TP2, 2 ATL values. That is buy. But remember, if your price if your trade is more than 100 pips, so that's why you are putting this the first buy. But after this buy order, you come and think if your trade goes to 100 pips, even if it has not hit your 1 ATR value, make sure to break even with 10 pips. Do not wait for your price to come back. That's why you don't want to give the money back to the broker, the one that you've taken. So it's the same case as here, that even if the market moves up and hits 100 pips, make sure you are booking it again at 100 pips and break even with the 10 pips. This is the whole idea here. Then you have another one here. This is for the sell order. In the same case, when you are selling, remember it's bid now. Bid is the selling price minus 1 ATL value, because we are going down. Now we are not going up. Minus 2 ATL value, the same. If the price goes from your selling price to 100 pips, you are good to break even. That is it. But then after the price moves up, here down this way, we are saying that you need now to keep following your price. So this is why we say that if it is your buy order moves 100 pips, then you need to break even here. The stop loss comes from the negative side to the positive side with the 10 pips. Then from there, if it continues moving up more than 100 pips, then you have to keep on pushing your buying order and let it trade the price with 100 points. That's what we mean by this code here. The sell order is the same. It is bid minus 10 points for the break even when the price hits minus 1 ATL value or when it continues dropping down. Then from that point, the price then can continue trading your price with 100 points. This is all the same thing we mean. But all in all, if your price ever hits 100 pips, do not let that price to come back. As I told you, break even with the 10 pips. Even if it does not hit 1 ATL and you are at 100 pips, break even, money management is key every time you are coding, because if you're a good money manager, that's what defines you and that's what separates you from other traders. And that's why you make more profit than the others. That's what we do it, and you continue trading with 100 pips until the trading stops, comes back and hits your stop loss, or your bid or your ask or buying or selling price continues and hit the 2 ATL values. So remember, stop loss is 1 and it is intact. 1 ATL values. TP1 can be either 1 ATL value or 100 pips. Then you break even. Number 2, we've said that TP2 is intact. 2 ATR values, no change. The only thing is changing is if your price hits 100 pips, and because we have other candles, and I want to demonstrate that, we have other candles like, we have trades like Euro CHF is one of the notorious, Euro CHF and Laudi CHF. These prices, let's see, like Euro CHF, you see, 1 ATL value is equal to 80 pips. That means this one, instead of it hitting 100 pips, it will hit 1 ATL level. But we have other orders. Let's say an example like pound versus the dollar. The pound 1 ATL value is 140 pips. 140 pips. That means instead of it hitting 1 ATL value, it will hit 100 pips. That means when it hits the 100 pips, break even your trade. So that's how you do it. Make sure you close the first trade, break even the second. And that is the smartest way you can use to trade these markets. I don't think I have any other things. So for those who've been asking about to set your TP yourself for every trade in our VIP signals, or other members in our main group, make sure you follow these rules or any other person out there. This is the best way you can be able to manage your trade. And for that reason, that's how we do here at StiffX Trading Flow. Just learn as you earn or earn as you learn. This is how we do it in a smart way so that you earn as much as possible. Thank you.